7.4 trillion. That's the biggest pile of cash in human history just sitting on the sidelines. It's earning around 5% in money market funds, but the moment the Fed starts cutting rates, that yield disappears. And when trillions of dollars suddenly stop earning, they move fast. They move somewhere else. So right now, we're standing on the very edge of the biggest liquidity rotation in history. And every time we have seen this setup, which was in 1998, 2003, 2009, the rotation that followed ignited a historic bull run. We saw stocks soared, housing exploded, and everything risk on ripped higher. And now, for the first time, Bitcoin exists right in the path of that capital. This is the setup for the largest liquidity migration the world has ever seen. And the fuse has already been lit. So happy Friday, guys, and stay with me, because by the end of today's video, you'll understand how the coming liquidity wave could reprice Bitcoin faster than anything we've ever seen before. You'll also understand why this window in time might be the final chance to position yourself early if you're not already in position. So let's dive in. First off, let's talk about the hidden pressures in the system, because behind the scenes, the US financial system is running hot. The liquidity to debt ratio has slipped back into the stress zone, meaning there's less cash in the system to support record debt lows, as we're seeing every single day it increases. And the Fed's reserve balances have dropped below 3 trillion for the first time since 2022. The Treasury has been rebuilding its cash pile above 800 billion. And every new bill it issues drains liquidity from the banks, the safety valve that used to catch that outflow. The Fed's reserve repo facility is basically empty now, which means every new Treasury bill pulls money straight out of the banking system. We saw repo rates jumped to 4.36% mid-October. These are the short-term interest rates banks charge each other to borrow cash overnight. And when they spike, it's a clear sign that liquidity is drying up and cash is getting harder to find. Banks have already tapped the Fed's emergency repo window, and Powell admitted, "We're approaching ample reserves," he said. Quick translation, that means quantitative tightening is ending soon. And the last time reserves fell this far and repo rates spiked like this was in 2019, right before the Fed stepped in with hundreds of billions of dollars in fresh liquidity straight into our system, which made its way straight into the crypto market. And right now, we see history is repeating itself, except this time that liquidity will flow through a market with crypto rails already built. Now let's talk about the policy fuse that's igniting things. We see the Labor Department released a rare exception CPI report during this recent government shutdown, showing inflation is cooling to 3% instead of 3.1%. And within minutes, we saw the S&P 500 futures jumped 1% to new highs. And that single print has given the Fed political cover to cut rates. With the upcoming Trump-Xi meeting and talks of tariff delays, it seems the stage is set for synchronized easing. And we see market psychology has flipped completely. Back in April, managers were bracing for a recession, but by October, surveys have showed almost no one expected one. Fear still peaked, however, and the VIX hit 29 as investors panicked over the banks and the broader economy. The VIX, often called the market's fear index, tracks how much volatility traders expect in stocks. And when it spikes like this, it usually means sentiment has reached an extreme. And October always plays the same role. It shakes out investors right before the year-end rally. And this time, that fear flush has hit exactly as the macro trigger appeared. Now, if we take a look at money markets, we see assets have exploded. They've doubled since 2019 and now total more than 7.4 trillion. Just think about that for a second. 7 trillion just sitting in cash. Parked in funds paying around 5%. And here is where it gets wild. When the Fed finally cuts rates by 150 to 200 basis points, those yields collapse overnight, meaning more than 100 billion in income disappears. And when that happens, the search for return begins immediately. That money will move. And even a tiny move from that pile changes everything. 1% of that money moving, for instance, is $74 billion. 10% is $740 billion. 20% is almost $1.5 trillion, more than the economy of most major countries in the world. And every time this has happened before, it's kicked off a massive bull run. In the late 1900s, it fueled the tech boom. In the early 2000s, it lit the housing rally. And after 2008, it triggered the melt-up that tripled global markets. And now it's happening again. And this time, as I was saying in my intro, Bitcoin sits right in the middle of the stream. We're talking about a dam ready to burst the moment policy shifts. And when those yields drop, capital is going to rush into anything with upside: stocks, gold, and especially crypto. The pipes are ready and the institution rails are built. The money has a clear path straight into digital assets. And the smartest money in the market already knows this, and they're already moving. For instance, a whale with 100% win rate just opened $131 million long on Ethereum, locking in $16 million in profit in 2 weeks. Moves like that don't happen by accident. These people know. This happens when big players know what's coming. And on-chain data tells us the same story. Bitcoin relative unrealized loss, which is basically the percentage of holders sitting at a loss, has stayed under 5% since November 2023. That's the level we see during strong, healthy bull phases. And mid-sized Bitcoin holders, the ones holding between 100 to 1,000 Bitcoin, are still quietly stacking, just like they do at the start of every major rally. So you see how patterns are repeating themselves. And Ethereum's chart is showing strength too. It's breaking through a year and a half of resistance. And every time ETH has been this oversold since 2023, it's launched into a major rebound. And we see institutions, as we cover basically every day here at my channel, are starting to make their move as well. JP Morgan will soon let clients use Bitcoin and Ethereum as loan collateral. Welcome to the future. It's fantastic to see. And this will be an extension of their ETF collateral program that opens the door for even more liquidity. And in Q3, Ethereum's ETFs actually brought in more inflows than Bitcoin. 8.6 billion versus 7.5 billion. That's the first time this has ever happened. And this shift shows institutional demand is widening beyond Bitcoin and into the rest of the crypto market. Even the short-term data lines up. Bitcoin ETF outflows, which usually mark local bottoms, are clustering again, signaling that sentiment's about to flip. And liquidity maps show short positions stacked above current prices, which is the perfect setup for a squeeze once momentum returns. So you see, everything points to quiet accumulation under the surface, beneath the surface, and a market getting ready for its next expansion phase. Now let's quickly talk about the liquidity cycle, because global liquidity is already turning too. The M2 supply curve and gold are both breaking higher, while Bitcoin is still trading quietly. And we see the Fed is about to formally end quantitative tightening. The last time this happened, altcoins bottomed against Bitcoin and went on a 750% rally or pump. Liquidity always moves in waves. It leaves cash and bonds first, then flows into equities, and finally into hard assets. Crypto is always last, and that's usually where the biggest returns happen. And right now, every single one of these signals is flashing again, and they're flashing the same message. The liquidity drain is over and the expansion cycle is about to begin again. We see gold has already made its move, stocks are sitting at record highs, and crypto is still waiting for that rotation. Once the rate cuts land, that 7 trillion spring will finally release, and it won't stop at Bitcoin. It will move through Ethereum and into the next wave of altcoins. So as we close out, we see 7.4 trillion is ready to move. The Fed is shifting, and on-chain data shows the strongest hands never left because they know better. So I would hope we be the same, because when yields collapse, the hunt for returns begin. And in a world of finite digital assets, that liquidity has only one direction to flow. Bitcoin's supply is fixed. Its rails are global. Institutions are already building the bridge. And every cycle has a moment when disbelief turns into realization. And that is this moment. The Fed's pivot will unleash the largest wave of capital ever created, and price discovery will accelerate across the entire digital asset market. We've been putting the work in. So here at my channel, my team and I, we've been putting in the work to bring you clear, data-driven content that keeps you ahead of every market move. It has you seeing above technical analysis, because it is part of the story, but it's not all. And you found value in the type of content we bring you here, then just like the video, share it with a friend or family member that needs another take, needs to know what's going on, and make sure you have your notification bell on so you never miss a video. I love you guys so much. That's a wrap for this week, and I'll catch you guys here on Monday. Take care.